What's up, traders? Welcome to the official Trade Talk channel where I show you how to make consistent returns in options. Different intro, I know, because we're doing an options playlist, and I want you guys to really take this seriously, especially if you're in the United States of America. You don't know how to trade options and you're following me for my awesome technical analysis, which is undeniably the best in the biz. You definitely want to learn how to trade options because you've seen me trade Bitcoin on futures. You've seen me trade Forex. One thing I have never done on the internet is trade options. All right. So what I have done is I have went out there to a new platform, somebody I've never used before, and they are called tastytrade. Of course, there is a link in the description below. If you use that link, make sure you sign up with a minimum of $2,000. The reason is simple. You need that in order to sell options because a lot of the strategies that we are going to be talking about will include selling options. And if you use Thinkorswim or any other broker out there, you're going to need to have a $500 million account just to sell one option, one call or one put. It's ridiculous, the buying power that is required out there. tastytrade is different. When you sign up for this account and when you're going to deposit your $2 grand, $5 grand, 20 grand, whatever, make sure that you say that you are an expert at everything. Even if you're not, say you are, because you need to get access to trading futures. And you also need to have access to trade options on futures, because they have micro futures out there for the smaller account people, and it's fantastic for consistent return. A vertical spread is called a vertical spread because the strikes are listed vertically, and when you buy a spread or sell a spread, you are essentially doing this. You're going out there, you're buying one option. For a long option, you buy a high strike close to the money, and then you go out there, like, I don't know, let's say $5 wide, and you sell another option. Woohoo! Vertical spreads explained. Let's go. Let's go. Just kidding. All right. We're nowhere even close to being done with this video. Are you still there? I hope you're still there. Why do we use vertical spreads? I'll tell you why. A vertical spread, you can buy a call at one strike and sell another call at a different strike. Or you can do it with puts too, but let's stick with calls. Buying vertical spreads. That is a long option strategy. It is used when a stock is going in a specific direction or stay flat to sideways. Using vertical spreads is a way to make your position cheaper than just buying the option. Let's stick on this point for a minute. So if I want to just say, I know that SPY is going up, dude, it's going to 470, and I'm going to buy this 449 strike 43 days out. What did I mean? Well, I'm buying this strike, which is $449. That's the price of SPY, and I'm doing it 43 days out, right? So I want this thing to go up above this line, that little yellow faint line. That's in the money. This is out of the money. In the money, out of the money. In the money, at the money. In the money, at the money. Out of the money. In the money, at the money. Out of the money. In the money, out of the money. At the money. Here we go. We're going to buy a vertical spread because we think the stock is going to go higher. However, if I want to buy this thing, it's going to cost me $1,000. Well, if I only have a $2,000 account, that means I'm literally risking half of the account.
Not a great plan.
All right. You're risking half of your account. Now, to be fair, you do have a 50% chance of being right. All right. So the reason we use vertical spreads is because we don't want to risk $1,050. So what we do is we go down and we sell another option close to where we're at. So basically, you're going to be able to make the width of the spread. Say that one more time. The max amount of money that you're ever going to be able to make on a vertical spread is the width of the spread minus the premium paid. So we're at 449. Let's go out $5. $5. Let's go $5. Sell, damn it. All right, so there we go. 454 to 449. That is a $5 wide spread. Don't believe me? All right, fine. I'll make it a $5 wide spread by going down to the 450. Go down. There you go. Thank you. And let's go down to the 455. There we go. There we go. 450, 455. $5 wide spread. What's the max amount of money you can make on a $5 wide spread? $5 minus, that's right, the amount paid. On this particular option with these particular prices, which are wrong because the market is closed, you are risking $3.04 because that's how much money it is going to cost you to buy this spread. So this comes out of the spread. So if $5 is the width of your spread, you have to minus $3.04, and that's your max loss is $304. Why is that? Because we went further out of the money. When you go close to the money, you're gonna be able to make spreads when the market's open and you have actual prices. You're gonna be able to make spreads that are like you'll risk $30 to make $70, right? All day long. I can do that all day long with vertical spread. All right, vertical spreads. You buy an option close to the money, you sell another option further out of the money. That is a vertical spread. So we're gonna buy this one, we're going to sell this one. We're going to have a $2 wide spread right here. Max loss, 121. Now, your max profit is $2, but you're paying $1.21 for it. So that means your max profit is only going to be $79. And as you can see, the potential profit over here is 50%, right? Because it's directionally biased. It's directionally biased. Vertical spreads are directional bias trades. It's a way for you to limit the amount of premium paid to get into an options position. So if I want to say I want to go short because I think this thing's going down, right? I think it's going down. So turn that to a buy. Actually, you'd have to buy there. That's where you'd sell. So buy the 262s. It's going to cost me $262 to buy this, and my max profit is $44,000 because it can only go to zero. And the SPY is never going to zero. If the SPY ever goes to zero, don't worry about the profit you made anyways, because it won't be worth anything. Okay? That's just general economics there. All right, so moving on. Now we want to go out here and we want to sell a further out of the money option. This would be a $3 wide spread. Look at that. Boom. Just going to the put side, we made our max profit $219, our max loss $81. That is better than a 2-to-1 risk to reward, right? It is. It simply is. You're risking $81 to make $219. But what has to happen? That's right. The in the money line has to get up there or close to it. You could get up here and you wouldn't make the full 219, but you'd still make pretty decent money, all right? So this is the way to grow a small account. It's the way you can limit your downside. Obviously, it limits the upside, but it limits the downside, which is the most important part of trading. You guys gotta limit your downsides, man. You just gotta do it. So you gotta take these trades, even though you're like, I don't want to just make $219, dude. I want to make $1 billion. Well, you can try, but you're not going to do very good because your probabilities are not good. You could simply buy a cheaper option. I could go out here and buy the 427 puts and only pay $29. And that means I can make up to $42,000. But I can tell you right now that you have a 5% chance of this option ever getting anywhere close to the money, let alone in it. All right? Now, is it possible that this option would in fact make money? Absolutely. If the SPY were to have this incredibly huge down day, that would jack up the VIX, that would jack up the implied volatility. Instead of being at a 13.9%, the implied volatility would go up to 87%. That by itself will increase the value of the option you bought to $100. And then boom, as the SPY is absolutely falling down and going to zero, your option is getting closer and closer and closer to the money. So the value is going up and up and up and up and up. Yeah, it's possible. It absolutely is possible to make money going way out and buying. Would you shut up? Whoever you are. Anyways. All right. So yeah, 5% probability of you making money. So we like to try to go out there and do the high probable trades, right? Vertical spreads limit your upside, but they limit your downside. And a vertical spread can only be put in or put on in the same series. Calls with calls, puts with puts. You can't go out there and buy a 440 call and then go out there and sell 440 put. You could, but that's not a vertical spread. All right, so let's just do it. Let's go buy this. Let's go sell this. What do we got? Oh, we got a max profit of infinity, but we also got a max loss of $45,000. So don't do it, right? Don't do it. No, vertical spreads are the same series, same expiration, same side, all right? Calls with calls, puts with puts. That's a vertical spread. An in-out spread is the same as a vertical spread, only you're going in the money. You're buying an option in the money, you're selling an option out of the money. That's an in-out spread. Buying an option in the money, selling an option out of the money. In-out spread. It's a vertical spread. It's the same thing, all right? And you can do that. You absolutely can. You can go out there and you can buy that. You can go out there and you can sell that. And boom, there you go. But if you go to the put side, it'll be way better. Why? Skew. We'll get into skew later. Oh, that's not in the money. There we go. Now we're in the money. Let's go ahead and boom, sell that. Boom. Look at that. 136, 164. That is a 2-to-1 risk reward. That's because of the skew. The skew raises the price of the puts. And since the skew is high right now, puts are expensive. So that's an in-out spread, or also known as a vertical spread, but with one strike in the money. All right. All right. That's a strategy, guys. That is the first of many strategy videos to come. I really hope you enjoyed it. It's been a long time. I know. I'm sorry. What time? How long? 21 minutes. Actually, it's going to be 5, maybe 12. All right. Thank you guys for being here. I really appreciate it. Make sure you guys trade safe, trade smart, and as always, happy trading.